Okay, so last class, we talked pretty extensively on project finance and the capital budgeting process. So looking at replacement analysis versus expansion, looking at elements of capital budgeting techniques, including looking at all the components of the cash flows, the initial cash flow, the terminal cash flow, the operating cash flows, incremental operating cash flows. And we walked through a should we do this or not expansion question. What we're going to look at today is kind of taking it a little bit further to a should we replace an old machine or should we replace an old piece of equipment or building or not. And this becomes a look at incremental cash flows. How much more or less are you going to have? And it kind of adds in another layer of complexity. It's about as complex as you're going to get in a typical capital budgeting problem. So let's walk through some of the assumptions and let me know where you think these things fall. So we've got the purchase price. Where do you think the purchase price falls? Terminal, operating, or initial? Initial. So this is an initial. Let me ask you a question. If you have a piece of equipment, the old lathe, is the purchase price this old lathe? A lathe is a big thing that turns and you can cut stuff on it. Do you think that purchase price is important? Why?
You want to pay it back at least with extra interest that you have a higher NPV.
Because it takes away from how much other money you have to do with.
Takes away from your income
How?
by purchasing it.
Well, what if it's already purchased? The old lathe's already there, right? You're figuring out whether to replace it or not.
The sunk cost from 5 years ago, but you still need to know the price
No.
so you can calculate the book
No.
value.
No,
after depreciation.
it doesn't matter because it's already a sunken cost.
Right. So it's already a sunk cost from 5 years ago, but it's important because you have
5 years remaining.
remaining depreciation. And so you have to calculate potentially the remaining depreciation that will then be accelerated. So you need to calculate depreciation from when it started to now, what's left as the book value, what the salvage value is, and all that good stuff. So it's important, but you don't use that purchase price directly as an outflow cost. Salvage value, terminal, operating, or initial. Terminal, in most cases. Salvage value today, terminal, operating, or initial. Initial, because if you decide to replace the old lathe, you're going to scrap it, and that money will come in as an initial cash flow. You'll buy this one and sell this one. Decrease in operating costs. These are savings. So it's shown as a positive. Make sure you don't assume that operating costs are always negative. You've got a decrease in operating costs. Why is that important? So it's saving you money. It's not saying here's what the total operating costs are. Remember, we're looking at what's the change in cash flow. And so it's a decrease in operating costs. It's going to be a positive cash inflow if you put the new machine in, and that is going to be an operating cash flow. Increase in net working capital, initial, terminal, or operating.
Terminal and initial.
Terminal and initial. You increase net working capital, so that's an initial cash flow. You have to go buy additional inventory or you have to buy something. And then at the end, remember, you get that back. So changes in working capital tend to be both initial and terminal. And then depreciation and a marginal tax rate, where does that come into play? Initial, operating, or terminal? Operating for sure. Initial in this case, and terminal when you sell it. And here's why. You're going to have depreciation on the old lathe, you're going to have a sale, and you're going to need to be able to figure out if you have a gain or loss. Tax rate comes in. During operating, tax rate comes in to determine what the impact is of the change in operating costs plus depreciation changes. At terminal, the tax rate comes into play and depreciation comes into play because you got to figure out if you have a gain on sale, which, by the way, how long is this going to depreciate? Over 4 years, because it's a 3-year makers, which has got this half-life convention. How long are we going to be looking at it for? 5 years. So at the end of this, do you think you're going to have a gain or a loss on sale? You're going to loss?
So,
Well, I guess if you think that if you consider the increase in operating costs.
So let's just focus on the piece of equipment. You bought this equipment for $9,500. It's going to depreciate over essentially effectively 4 years, 3 years makers. You're going to hold it for 5 years, and at the end, you're going to salvage it for $2,000. Do you think you're going to have a gain or loss for tax purposes? A gain. Why?
Because you have, so meaning that you can have it for 5 years, you're only going to pay for 4. So the last year, you can have it for, let's say, 3, and then you can get the salvage value.
Perfect. You fully depreciated it to 0 for tax basis. And so then when you sell it for $2,000, the IRS needs to get their share of your profit on the sale. So let's walk through the sale of the old lathe. Because what we're looking at is we have to compare the difference in the cash flows. And so the first thing we're going to do is we go, okay, if we're going to replace the old lathe with a new piece of equipment, we need to figure out how much we're actually going to get in cash flow from getting rid of the old lathe. So we could sell the old lathe for $1,600 or 1.6 million, I guess is the way this is set up. So $1.6 million, we saw that on the assumptions, the set of assumptions that were given to us. Tax on sale of asset. So we're back into, good Lord, we've got taxes. So let's walk through what those taxes look like. In this particular case, you've got to determine the book value of the asset. It's equal to the depreciable basis minus the accumulated depreciation. So in this particular case, what you've got actually doesn't give you enough information to calculate that. I probably cut something off. So what you've got in this particular case, and I'll walk you through what the assumption is this old lathe is 10 years old. It's got 5 years of life left, but it's 10 years old, and it's been depreciated at $500,000 a year straight line. So this doesn't have makers. This is a 10-year straight line. So there's 2 pieces of information missing, which is how old the lathe already is, and the depreciation method. That 500 should be 500 straight line, and there's a 10-year life. My bad. Apologies. So the asset costs $7,900, and it's a $500,000 straight line depreciation, and we've had it for 10 years. So you've got $5,000 of accumulated depreciation on the asset, which leaves you with a depreciable basis of $2.9 million. Everybody follow that? Again, apologies for my lack of adding those 2 pieces of information. We sold it for $1.6 million. That was given. You have a depreciable basis left, the book value of $2.9 million. That leaves you with a loss of $1.3 million. Now, if you have a loss, you get cash flow from taxes. So instead of paying taxes because you have a gain, you get a tax shield because you have a loss. Essentially, you've got an asset that you're selling for less than the book value. And so you've got $520,000 of tax benefit. You got a $1.3 million loss and a 40% tax rate. You follow how we got to this point? Okay, so now we go, okay, we sold the thing for 1.6 million, and we've got a tax benefit from the sale of 520,000, which gives us an initial cash flow from selling the old lathe of $2.12 million. You've got the 1.6 million from the sale to the third party and $520,000 of tax savings from the IRS. So now we take a look and go, okay, where are we at with respect to the new machine? We've got a new machine that we're going to pay $12 million for. We've got an increase in net working capital of $1.4 million, minus cash inflow of $2.12 million from the sale of the old lathe. So our initial cash flows are $11,280,000 out. Buy the equipment, increase the inventory, sell the old equipment. Any questions on how we got to those numbers? Now we start getting into net change. The challenge you run into in a replacement situation is we're looking at what we would have had we kept the old lathe versus what we're going to have with the new piece of equipment. So in this particular case, if we kept the old lathe, we get $500 of depreciation straight line for 5 more years. But if we get rid of the old lathe, this depreciation goes away. And we replace it with the depreciation on a new piece of equipment. And if you look up 3-year makers in Google or anywhere else, you're going to find that 3 years makers, as I mentioned last class, is 4 years long, which makes perfect sense, right? And it's got 33% gets depreciated in the first year, 45% in the second year, 15% in the third year, and 7% in the second year. A little aside, the reason that that's done that way is to incentivize, it's part of the tax code, and it's to incentivize folks to make these investments and get their tax shield earlier. Because if you get your tax shield earlier, it's got a higher net present value. And so instead of making this straight line, the IRS said, we're going to try and incentivize folks to buy more equipment, to buy new equipment, and therefore give you more depreciation early so that your present value of your expected future cash flows associated with the depreciation tax shield come to you sooner, and you're more likely to say yes to a project. So this type of analysis that we're doing in this class has policy implications that are reflected by Congress when they set the tax code. So finance matters. In this particular case, we're going to look at the depreciation. We're going to say, okay, depreciation in year 1 is 3.96 million, year 2, 5.4 million, 1.8 million, $840,000. We then subtract the depreciation we would have had already. Because the old lathe, we're going to see depreciation anyway. So we want to see what the increase in depreciation is going to be over the 5-year life of this project. 1, 2, 3, 4, 5. Because as we noted a couple minutes ago, there's no remaining basis left in the 5th year. We're probably going to have a gain on sale. But this old machine is getting depreciated at $500 a year straight line over an extended period of time. And so it's got additional depreciation in that 5th year. So this is a change in depreciation. I can't emphasize enough that what we're looking at in a capital budgeting problem, when we're looking at replacement, is the changes. We're not looking at the absolute, what's the depreciation. Where I have made most of my mistakes on these kind of problems in the past is I use these numbers instead of these numbers minus the original depreciation. So here we go to the supplemental operating cash flows. The changes in the operating cash flows during the 5-year hold period. The assumptions that we got at the beginning said we're going to save $3.5 million a year, right? So we got $3.5 million a year of decreased cost, which equals increased cash flows. However, every time we have cash flow, we have profit, the IRS takes a piece of it. So we assumed a 40% tax rate. So for the savings, we get $3.5 million, but we only get to keep 60% of it because 40% of it goes to the IRS. On the other side, we have the depreciation, and we get to keep 40% of that because it's a tax shield. And so in each operating year, you can see that we get to keep 1 minus the tax rate of the 3.5 million, and then we take the depreciation from the last schedule, multiply it by the tax rate, and add the two together. Your supplemental operating cash flows for this particular project are plus 3.484 million in year 1, plus 4,060,000 in year 2, plus 2.62 million in year 3, plus 2.236 million in year 4, plus 1.9 million in year 5. That's your total supplemental operating cash flows. That accounts for the change in that operating cost and the change in depreciation expense. Note, it's change. Remember, change. It's not the absolutes. So let's talk about terminal cash flow. If they buy the new machine, we sell the lathe. If we don't buy the new machine, we keep the lathe. If we sell the old lathe today, the company can't sell it for $400,000 in 2022, which means it doesn't receive the $400 in 2022. So when you looked at the original cash flow assumptions, it said, okay, here's a terminal cash flow. And we said, yes, it's a sale, it's terminal. It's only terminal in this particular case if we decide not to proceed with the project. It's a relevant cash flow because if we don't purchase the new machine, we get that $400,000 in 2022. Thus, a part of $20,000 should be recognized as a cash outflow in 2022 because we're foregoing that opportunity. We're getting money today and we're foregoing money in the future. Generally, you want money today over money in the future. But because we're looking at changes in the cash flow, our cash flow changes by getting that 2.1 million of the sale and the tax benefit this year, and it changes by losing the 400,000 in the 5th year. We talked through this at the assumptions. It's good to make sure that you kind of think this through outside of the spreadsheet, because you'll identify mistakes in your spreadsheet a lot easier if you go, you know, this should be 0. It should be fully depreciated. I should be having a gain because I've got 4 years of depreciation. I've got a 5-year asset. You should be able to answer those questions like many of you did right off the assumptions tab without having to do any of the calculations. The gain on sale we calculated is going to be $2 million of sale. We talked about it's got a 0 book value because it's fully depreciated. So you're going to have a $2 million gain on sale. The tax is going to be 2 million times the tax rate, or $800,000. So the net cash flow from the sale is 2 million you get from the third party minus the 800,000 you have to pay to the IRS. Your net cash flow is $1.2 million. Any questions on how to calculate that terminal cash flow? Okay. So here's the 3 components. We've got the net cash flow from the new machine, 1.2 million. We just walked through it. We've got the loss on the salvage from the old lathe, because remember, we're looking at changes in cash flow. That 400,000 would have come in year 5. But since it's no longer going to come in year 5 because we're selling that old lathe in year 0, you lose $400,000. And then you've got a return on net working capital. Remember, we said net working capital is both an initial and a terminal cash flow. So you get that 1.4 million back. So your terminal cash flows are $2.2 million. So there's your net cash flow. Kind of spread it out in the spreadsheet. Year 0, 1, 2, 3, 4, and 5. Let me ask a quick question. Do you think this is a good project or not? Why?
The income exceeds the initial outflow.
So the income over time, 3, 7, 9, 10, 12, 16, 16.3 million or so, exceeds the 11 million that you outflow. So it's a good project. Who agrees with that?
What's the rate?
Oh, what? Jason, what was that?
What's the rate?
What's the rate? It depends. We don't know yet. Trick question. It depends. Because we don't know what the discount rate is yet. We don't know what the project risk is. We don't know what the corporate risk is. We don't know what the required rate of return is. In Excel, what we would do is we go, okay, there's 2 ways to look at this. You highlight this and hit equal IRR, and it'll calculate out for you an internal rate of return. Or you highlight this, you have a hurdle rate or a required rate of return that you enter, and it'll calculate for you a net present value. If the net present value is positive, is it a good project or not? Yes, it's good. If the net present value is negative, is it a good project or not? No. But we don't know that yet because we're missing that one critical piece of information. Every finance problem essentially boils down to 2 things. It's a set of cash flows and then the discount rate associated with the cash flows, which represents the risk for either the project or the firm. And so we're missing one component, which is that risk analysis. So let's use a 15% rate of return. Required rate of return of 15%. We run through and discount, and here's our answers. Net present value, negative $141,000. IRR, 14.46%. Payback of 3.5 years. This kind of payback is greater than 5 years. Somebody do a little bit of analysis. Unpack for me these 4 components across the bottom and the net cash flow, and tell me why you think this is a good or bad investment, and give me a little bit of color on each of those 4 things at the bottom. And you don't all have to step up at once, and you can kind of take turns. All right, what do you got?
Well, net present value is less than 0, so that's bad. Internal rate of return is less than the required rate, so that's bad. And then the depreciable payback is more than the length of the project, so that's bad.
Okay, so Jason just answered the entire thing. Essentially what you've got is a situation where you go, okay, the net cash flow is positive. So the initial kind of observation that was made that this is probably a good project because you've got $4 million more coming in than you're outlaying. That's not a bad idea. When you start looking at the risk associated with it and you discount the cash flows for that risk, you say, okay, this could be a good project, and it's close. I mean, it's right there, but it's not quite good enough. So the net present value is negative, which means if you undertake this project, you're destroying shareholder wealth. You're not creating wealth, which would be net present value positive. Economically, you're earning causing an economic loss, even though you're showing an accounting profit. That's the important part of finance. We're looking at the economics. We're looking at the cash flow. We're not concerned as much about the accounting, except to the extent the accounting impacts cash flow, like depreciation. In this particular case, we would show $4 million of profit on this project, and yet, as a finance professional, you'd say, reject this project, don't do it, because we're destroying economic wealth, we're creating an economic loss. And you can look at that, and there's three things, or three tells, and Jason hit all three of them, as to that's creating an economic loss. Number one, net present value is negative. Number two, the IRR is below the required rate of return. And number three, the discounted payback period is longer than the project. They all should align, by the way. IRR sometimes will be a little bit off, and modified internal rate of return will correct for that. But in general, you should see consistency across all three of those measures. The discounted payback should say no, the IRR should say no, the net present value should say no. And if you're getting answers when you're looking at a problem where one of these says yes and the other says no, check your calculations. If you're getting something where you're getting a dissonant answer, where you're getting something that doesn't seem to make sense, check your calculations. The back of the envelope analysis that Chris did and said, okay, this should be okay. We got a plus 4 million. I think it's going to be okay. Your gut kind of said it was close. Well, your gut said it was good. It's close. Use your gut. Don't just rely on the spreadsheet. If it looks really wrong, it probably is. So let's talk a little bit about putting risk into the equation. Risk is your discount rate. So project risk should be calculated and used to determine whether to proceed with the project. A lot of times we could calculate a corporate discount rate pretty easily. Go, okay, here's the debt and the cost of that, and here's a return on equity, and here's a beta, and we could calculate that out. But the project could dramatically change the risk profile of the firm. If you've got, and we kind of talked about it, you've got a sandwich shop, you decide to go into a 502 business, the 502 business is going to have a higher risk level. And if that's 3 times the size of your sandwich shop, you don't want to use your sandwich shop's cost of capital as your risk analysis for determining whether to enter into that new line of business. So you really need to look at the project level risk and how that changes the overall dynamics of the firm in the event that that project's undertaken. There's pros and cons to changing the risk profile of a firm. We're going to talk a little bit about, as we move into some of the corporate policy and decision making in the next couple of weeks, what considerations you should be looking at to either reduce or increase your beta, and how mixing all these projects together creates a portfolio that essentially represents similar to a stock portfolio, and you could diversify, and whether you should or not. But at the end of the day, for capital budgeting, you need to recognize the fact that a project can change the risk profile of your company, can change the risk profile up or down, and that we need to be looking at the project-specific risks rather than just the return on the existing assets and required rate of return for the firm. Does that make sense? So there's a couple different ways to look at it. There's standalone. So if you say my entire business is now this project, what's the rate of return required there? And you go, hey, it could be pretty high because I've got no diversification on my cash flows. I'm putting all my eggs in this basket. My required rate of return on the equity is going to be pretty high. The other thing you can look at it is within the firm. So you can have a situation where you go, okay, I've got a firm that sells both gas and electric cars. So folks know that they need cars, and when the price of fuel, when the price of gasoline goes down, the demand for gasoline cars will go up. When the price of gasoline goes up, the demand for gasoline cars will go down, and you should have a complementary demand increase in electric vehicles. So if you go, hey, I'm going to only be in electric vehicles, when the price of gas goes up and down, your demand's going to go up and down in kind of the same way. So gas goes up, electric vehicle demand goes up. If you're just gas vehicles, gas goes up, electric vehicle or gas vehicle demand goes down. If you combine those two projects, you now have diversification. You're still in the car business, but you've reduced the overall risk of the firm. And so you look at it in light of how adding an electric vehicle line to a gas vehicle line might be able to reduce the risk of the firm, and therefore the required rate of return might be lower now than it was before. Or if you're going to double down on something, you're going, okay, I'm going to take on some additional debt. We're going to double down on gas because I don't see a future for electric vehicles. You might increase by adding an additional gas vehicle line into your mix of projects. So you've got to look at within the corporation, within the company, within the firm, how does adding this project impact the risk profile? Because it could be, if it stands alone, getting into electric vehicles can be very risky. If it's combined with an existing product line where they complement each other, you may actually be reducing firm risk. And then the last one is beta, or market risk, the portion of an asset that can't be eliminated through diversification. Essentially, there's going to be things that drive the market up and down, that drive return or required return up and down, and you can't diversify that away. You can't take electric and gas, put it together, and eliminate the effect of interest rates or other exogenous variables that are going to impact market returns. And this needs to be factored in all the time. Any questions on these three components? Any question on how you can have two risky projects, combine them together, and actually reduce the risk associated with the firm overall? The same concept with this and these projects, the same finance concept applies for diversification of stocks, applies for diversification of bonds. You're diversifying by shifting your risk and looking at complements, looking at assets or projects or stocks that are not correlated. The returns are uncorrelated or opposite, you have opposite correlation. So this same concept applies to any financial asset. And these projects are nothing more than financial assets. They're designed to create return for you. So here's some ways to look at standalone risk. Sensitivity analysis. If you make some changes in your expected return, how does it impact net present value? So in this particular case, if you take a minus 10% deviation on the base case, so you say, okay, it was 3.5 million, it's now going to be 10% lower. How does that operating savings flow through? So you say, okay, I'm going to make an adjustment. I'm going to reduce that 3.5 million down to 3.25 million or 3.15 million. How does that change it? Well, it makes it a little bit more negative. 0, positive. So again, we've got, actually this one's not on the replacement case, this one's on the expansion case. So positive at 0. And if we say that the net cash flow increases by 10%, we see a 237% increase in operating savings. The required rate of return and NPV changes. In each one of these cases, we end up in a situation whereby, my slides are screwed. They're upside down. This is what happens when you go to bed late. In each case, the net present value remains positive, but you've got a change in the sensitivity. So when the operating expense changes, forget this slide. I'm confused. I've confused myself. I'm going to come back to that slide when I'm awake. This one makes more sense to me, so we're going to look at this. If we look at three cases where we've got a savings of 10,000, a savings of 8,000, a savings of 3,000, we say, okay, we got a best case, worst case, and base case. We calculate the net present value. We calculate the probabilities. You multiply the net present value by the probability, and you get the expected net present value. So in this particular case, we're looking at how much did we save, what was the net present value of that savings, what's the probability of each of those cases, and all you do is multiply across to get the net present value, the probability weighted net present value. We calculate out the standard deviation and come up with a covariance of variation for the net present value of 2.92. Essentially, what you're looking at is to compare that to another project and go, which one's got more volatility? Which one, because if you see more volatility, that equals higher risk. Because remember, risk is calculated as a change in our expectation. So if we expect something and it's not that, the probability that it's not that, the measure of the not that is a covariance of variation, which is this 2.92. You compare the two projects and go, this one's riskier than the other because that number is larger or smaller. Monte Carlo simulation is not something you're going to do in this class, and I don't think I did it as an undergrad. Monte Carlo simulation essentially runs a model over and over and over and over and over again to come up with an entire universe of potential outcomes. And then it goes, and here's all the probabilities of each one of those potential outcomes, so that it takes this essentially base case, best case, worst case, does it for every variable within the model. So you may have a base case, best case, and worst case for tax rate, for savings, for purchase price, for depreciation, for end of sale price, for the sale price at the end. And each one of those gets adjusted, and then it runs the model again, and adjust it and run the model again, adjust it, run the model again, determine what the probabilities are based upon analysis of each of those variables. And it gives you this large table of here's the expected outcomes associated with the probabilities and the covariance variation. So you've got this situation where a Monte Carlo analysis essentially runs a massive model, changes every variable, determines the probabilities of each, and gives you what would expect to be the expected outcome along with a pretty good statistical analysis of your outliers and what the shape of that curve is going to look like. We don't do that here. You should understand what it is. You'll hear more about it when you're out in finance world. People talk about, well, we've run a Monte Carlo simulation on this thing. A lot of times they haven't done a full Monte Carlo because they haven't changed every variable, but that's what a Monte Carlo simulation is. Within the firm, you need to look at, again, how that project relates to the other projects within the firm, whether it's a diversification or not. So whether there's a correlation and whether that correlation is strongly positive, positive, strongly negative, or negative, and how you combine those two things together to increase the expected rate of return and decrease the beta. Essentially decrease the risk, increase the expected rate of return by diversification of projects. There's a strong argument to be made that firms should not be the ones that are diversifying. The argument is you should buy, as an investor, you want to diversify. You don't want your firm to diversify. You want to be able to make those bets, not necessarily have a firm within the firm create those bets. So you'd rather have, I've got an electric car company, I've got a gas car company, I can buy stock in either one, I can mix it based upon my own required rate of return. I don't necessarily want the company to do that. However, management, as we talked about early in the semester, has an incentive to protect itself. Has an incentive not necessarily to go, okay, we're going to be a pure play anything X, but we want to diversify, which may ultimately reduce our returns, but it's more likely that we're not going to have a catastrophic failure, and therefore we're likely to keep our jobs. And so you're going to find that there's a lot of literature and a lot of studies around whether firms should diversify this way by mixing and matching negatively correlated projects within the firm, or whether firms should go, hey, we're a pure play X, we're a pure play Y, and allow the investors to determine what the ratio of those analysis should be based upon their risk analysis. And the last one is market return. We talked about beta, which is basically how volatile something is in relation to a market. So a beta of 1 equals market return. A beta of 1.5 is 1.5 times the market return. So if the market goes up 10%, something with a beta of 1.5 would go up 15%. A 0.5 would go up 5%. The rate of return required for the project is equal to the risk-free rate plus the market return minus the risk-free rate for the project. So what you're going to be looking for in this particular case is going, are there pure play companies out there that look like my project? Analyzing those companies, determining what the beta is for those similarly situated companies, and essentially extending that over to your project. It's very difficult to do. As a practical matter, each company has its own risks that it doesn't diversify away. So you'd have to look at the entire market, mush the things together, and try and come up with a beta that's project specific. Very difficult, not impossible, but you tend to have a lot of noise in your analysis. Any questions on this stuff? Okay. Have yourselves a wonderful long weekend. I will see you on Wednesday. I'm going to be in the next couple of weeks, I'm going to be setting a couple review sessions in the evening to go through some of these step by step. And I will look forward to seeing you next week.
I didn't think